Okay, let me share the screen now. All right, let me know when you guys can see the screen.
It shows that you're sharing, but we hasn't come up yet.
It should it should come here. There we go. Hey, good morning, everybody. It is February 1st, 2026. Pardon, I got a little scratchy throat here. I think it'll warm up. The coaching session for Alex and Louise and Ken. So, hey, good morning, everybody. Louise, you gave me a some input to address, but I did want to just kind of for the record, this was the list of topics from yesterday. We were all in the EdgeRater. We're starting a new series with Chris White, quarterly update of the work that we're doing as it relates to EdgeRater. It's me, Phil, and Griff, and Griff. And so I talked about the connection between swing templates and critical state templates. Swing templates in EdgeRater are the ones that we use to model the mechanical swing system. Critical state templates are the sniper patterns that are really geared for uh, the next day's trading. And they could turn into swing trades if it could be in the middle of a swing trade pattern and it also hits a critical state. A lot of times you'll see the mechanical swing filters will prepare you for a swing trade that is also in a critical state. Um, and then sometimes those critical state days turns out to be a really strong directional move, which is what it's supposed to find. And then that can attract momentum away from that critical state in the direction of the momentum of the first day of what'll end up becoming a swing trade. So sometimes the critical states grow into swing trades. Sometimes swing trades uh, highlight a critical state and makes it a really good day. So I wanted in that little session to make that connection. I'll be getting that video and audio from him, and we'll make that a lesson as part of our package. But I just wanted to. And then I spent a few minutes talking about the difference between a setup, which is an entry or a filter, and a full system. I spent some time on the complexity toolkit and why this is a systematic combination tool that I teach Army officers how to handle decision making at times of maximum volatility, uncertainty, complexity, and ambiguity. In other words, well optimized for trading. Um, and I made the point that there's probably a 99.5% overlap between the cognitive and emotional skills of combat decision making and that of trading. They both get you in the experiential and existential mode because it feels like survival and it's maximum stress and you're fighting against professionals. So there's a very strong relationship in the emotionality and the rationality between military work and trading work. It's the subject of a book I'm writing uh, with Mark from Alpha Mind. It's a little outfit in the UK that looks at trading psychology. So anyway, that's coming. You guys will have access to that. I'm ready to share my portion of that half of the book. So I think I'll get that rolled out this week. I then spent some time on AI as a second brain, and I used our coaching program as an example of um, the what I consider to be the right way to partner humans and AI, and that is each one doing what it does best, protecting the weakness of the other, human in the loop, human being trained by the AI, so that if you lose the AI or you lose the network, you're still operating with a full tank, much like airplanes in World War II used wing tanks to give them an extended range, and then going into combat, they could drop the tank. So there's the idea that the AI and the human form a relationship that improves the performance of both of them. Um, that's projects that I'm working on with the Army. As part of that, I wrote them a prompt engineering course of 35 lessons and a couple books that go in to support that, which I'll share with you guys. It's again, it's the kinds of things that pertain both to military and to trading. They tend to be how to think in an organized way about complex problems, how to find a good procedure to follow, how to use the AI to run that procedure and to pull information in from you quickly, and then to have it do the cooking and the reframing and stuff like that. It's I find it to be indispensable. I spent some time then going over did a speed run of trades from this week. I think we did eight or 10 trades to examine, and had a couple that were like in the swing trade range, but all of them, I guess if I was going to talk to a brand new trader that had no exposure to us, it would really come down to that phrase there, where's the fire? What is the burning urgency of that trade compared to all the other trades? Um, there's something unsettling about a fire. If I don't have a fire and then suddenly I have one, now I'm worried about it getting out of control. If I have a fire that's under control, like kick over the pot or something or knock the fire starts raging. If I don't have a fire, adding fire to that environment really changes the dynamics of it. So the metaphor of the fire uh, corresponds to that critical state. There's something abnormal about that situation that is going to cause large directional moves. Just don't know which direction. As the herd tries to run away from the fire, or as Luis was talking about, running away from the lion. And so, um, what we do is apply a statistical lens and pattern lens to look at the existing price action and to say, um, when does that become abnormal? And when can I therefore expect larger than normal moves? And how can I trade that in a way that lets me get much or most of that move? Um, and conversely, how do I know when that move is running out of steam? How do I know that it's breaking down so that I can get back to get out of that trade and exit? So that was essentially the themes and messages that I was trying to cover yesterday. And again, it turned out to be about probably an hour speech, and I'll get that added to our stack. But before we go, I'd ask you, let me just ask, since you were both there, is there anything on that we need to talk about today, or is on your mind, or is unclear, or I can go straight into talking about Luis's comments, and then my plan is to go over the weekend report and the Friday's daily report to talk about things I'm looking at that jumped out at me on the report that are going to I will be ready to trade next week. So let me ask you guys how you're doing and where you'd like to go.
Well, let me start. I don't have a questions from yesterday. I think it went well. The only thing I was surprised that he didn't like, did a sales speech like, if you like it, join us, and here's the price. But that's
Yeah.
his
Oh, for
business.
the Edge Raider stuff?
Yeah, yeah, today's
Oh yeah,
radar.
yeah, yeah.
Yeah. Um, but overall, thank you for that presentation.
Yeah.
You know,
Yeah, well, I
was
think
was
most of the all of the guys except maybe you two that are in there were already Edge Raider users. So
Mhm.
that was really us being a guest speaker to his people.
Okay.
So I think all of those people probably have Edge Raider.
Sure.
If my memory serves, we have a 50% discount for
Mhm.
him. I don't get any of that money. It's just it provides a discount
Mhm.
um, to our clients
Mhm.
for that tool. And if you're interested in that, I would say, if you talk with Griff and Phil, they
Mhm.
really use that thing every day,
Mhm. Yep. Yep.
and it replaces a lot of the daily report that I produce in an email. So it's a way to get uh, signal independence from me. I mean, I'm
Mhm.
68 years old. You know, I've
Mhm.
already had my first heart attack a couple years ago. So I really encourage people to become information independent. And so the TC 2000 bundle uh, is those are all the templates that I use.
Mhm.
And then the Edge Raider is the translation of certain specific systems into the Edge Raider, and it allows for back testing that TC 2000 does not do. So for folks that want to refine their understanding with back testing, Edge Raider is a pretty powerful set of tools, and it does a nice job of. He's got an auto framer built in there, so when you select the things that hit all the setups, it builds out the day trade and the swing trade frame to show it, which is a pretty nice time saver. It's pretty handy.
Mhm. Okay. Thank you.
Yeah.
Yeah, and
So, yeah.
one other thing that I wanted to ask, I prepared kind of short presentation, like my introduction,
Okay. Yeah.
background. So if we can go through that before you go through the weekend report,
Yeah. Yeah. Yeah.
maybe that will help me to understand some of the things.
Sure. For sure.
Yeah.
We'll do that. We'll do that. Sure. Luis, anything other than what we talked just prior to hitting the mic or hitting the record button?
Um, well, no, I thought the presentation yesterday was great. I really enjoyed it. Thank you for that. Get to know a little bit, understand the trader, you know, process a little bit better in the service,
Yeah.
what you can accomplish. Um, Very interested in all the examples that you showed yesterday, as far as last recent trades.
Yeah.
Uh, and I don't think there's ever enough of that. So, those are great, and the thought process amongst them are great.
That reminds me, um, you guys, if I haven't given you access to it yet, I will today. The bar by bar trading
Yes,
workshop.
I do have
Okay.
access to that.
I actually think that's probably the best uh, uh, education or training once you sort of get the rules in your head. Um, that's probably the best work we did on, you know, live trading, purposeful live trading, under the pressure of doing it in public. So the guys that were going through that, were having to make their decisions while being recorded and being watched by, 20 or 30 people. And that turned out to be really helpful for them. So I would encourage you to go through. It's one of those where each time we would reveal one more bar and what do we do and how do we adjust the trade and things like that. So I could probably be persuaded to update that and do some more. We'll see. It's time intensive, and I'm pretty lazy. We'll see how that goes. Um, that's actually better than watching me trade because it puts you in the driver's seat and gives you skin in the game. And I'm willing to do that if that's something you guys um, think would be helpful. Yeah, your earlier question, if I can summarize it, make sure I get it right, was you've done all the prep planning and the prep, you've got your targets ready, and then when the market opens, multiples of them start running in both directions. And now it's like I think you said, it's like being a lion ready to go, but the whole herd is moving. And how do I pick one, or how do I pick two?
Yeah, and
Managing that.
just to be very specific, this week, I remember, I don't remember which day, but I remember watching the price action on, I think it was maybe Tesla a couple days,
Yeah.
and another big mover that were actually moving less than half of the range that twice in a row. So I was ready for them for the third day. The same thing with Microsoft. I identified Microsoft based on the report that it was going to be a swing candidate based on the breaking the prior high.
Yep.
And I tracked it one full day and it didn't do anything. And then the next day that I did not track Microsoft for reasons because I was focused on silver, or I think it was.
Yeah.
Then Microsoft all of a sudden ran and I missed it. So I missed a couple of setups that I had identified that turned out to be great because again, the day that I was focusing on my 8 symbols, that specific day I focused on to watch the OR on 2 or 3 that I did not watch then, and then I missed those. So that was a little disconcerting too.
Yeah, one of the things that'll happen with the way we're trading is that you'll get something like whatever the conditions were that created the critical state here. This is like, say, a 5DD with a doji. And we have a very clear, if it breaks above the high, we're going to go long. If it breaks below the low, we're going to go short. And then if it goes long, we have a reason to believe that in the next 5 days, it could get back to the 10-day high. And so as soon as it starts moving out, if it was a perfectly rational line, it would behave like that. And then there's about 3 different ways that it could get to there. The first one is it kind of slowly, a slow roller that then accelerates because you only got a few people buying it, and then it starts to be successful, and then the momentum comes in. So you get that slow roller and then gaining acceleration. And then the other one you see is like, especially after doji and after a really long sell-off, this thing explodes with big positions as guys come in with size to buy it at the point of advantage. And then that attracts some momentum buyers until it starts to dwindle, and it's made that huge move into this, and it might even start tailing off. So the phenomenon you're describing is almost the confirmation that our technique works, which is to find things. What I'm trying to do is get the biggest move possible in the shortest period of time, like the explosion, so that I can cycle my money instead of waiting for the slow roller. I can get the explosion. Yeah. So what if there's a bunch of them that are kind of correlated? You could imagine a world in which Tesla, Palantir, NVIDIA, Google, the tech bros are all kind of collectively sold off and are poised in the critical state. And then tomorrow, surprise, all of them are running. one of the ways you can be ready for that contingency is if you look when you're doing your prep work and you notice that all these tightly related guys are working together. So I want you to think of the symbols that you have and say, what are the categories that they're in? That's a way to start thinking about that. So if I said this was all my tech bros in here, Tesla, Nvidia, Google, maybe Intel, BBAI, UMAC. So if all of those are going together, then I have reason to believe that's a sector condition. And then what I'll try to do on that is just pick one or two of my most favorite ones, and it would typically be um, Palantir and Nvidia, because those tend to be once they start moving, they tend to attract. It's one of these. Once it starts moving, it tends to attract momentum followers pretty quick because everybody has to own them. Sometimes you'll see the smaller caps like UMAC or BBAI or AI or AVAV. There may not be a large institutional following, and so unless they might move and then just stop because there's no follow through. So if I notice that one of my sectors has a lot of symbols that usually work together, then I'll try to be super prepared for one or two of them ahead of time and just disregard the rest. Then if they're moving, I got them. If they're not moving, then I have time to go search. So what does that not moving look like? Well, the first thing that I'm going to look at is the gap. So about 5 minutes before the opening, in 5 minutes, I should be able to look at my little stack of 10 symbols that I've prepared and say, based on the indication of the opening, which ones are going to have a large gap and which ones are going to have a large adverse gap. What I'm not interested in are the ones that are very close to zero. So I'm looking for a big positive gap and a big negative gap. And then what I'll look at to see which way is the S&P going. If the S&P is a big positive gap, I'm going to interpret that as a lot of buying pressure early, and the market's going to go up in the first 5, 10, 15 minutes. So I'm probably going to concentrate on the ones that are also gapping up because they're going to be correlated with the market. If the S&P is kind of just in the middle, then I always go look at the negative gappers because it's my belief that this is where fear lives, whereas greed, fear of missing out, lives up here. This is existential worry. So if something is off of this list, and here's the opening, here's where it closed and here's where it opens, there's some reason why that it gapped down, some overnight news usually. And so when fear is already in that, I feel like I can bracket that. And then if it starts dropping right away, that was like silver on Friday. Dude, off we go. That's like always going to be my favorite is unless the market itself has a huge gap up. If the market is flat indication, or if the market has a negative gap, I'm going to concentrate on the ones that have an indication of a large adverse gap because my first play is going to be to follow that south once so it opens here, it breaks my little R5 or R10 box, and down we go. So on that one, as soon as it opens, I've got either an R5 or an R10 box. So an R10 is just to review the bidding, a range stat move divided into 10 equal segments. So 1/10 of a range stat is the R10. So if that thing opens here and I put an R10 to the downside and an R10 to the upside, as soon as it breaks down below that R10 value from the open, as soon as it breaks down that distance, I'm short, and now I have 9 boxes of gain for a range stat move to the downside. So that, as an example, that's what silver did. If I take that same range stat, and I break it into 10 again, and then I combine that and take two boxes together, that's what I would call an R5. And what that means is that there's 5 of those boxes in a range stat. So it's twice the size. So 2 times an R10 equals an R5. And that just gives you a little bit more wiggle room. So if that was the open, the R10 entry would be 2 boxes. And then there would be 8 R10s or 4 R5s as the minimum manageable, or I'm sorry, as the maximum reasonable intraday move. So anytime there's a gap, anytime there is a large adverse gap or a large favorable gap, the probability that we're going to see a range stat move that day is increased. So it's not irrational to say, by concentrating on the biggest gaps, I'm steering towards the ones that are going to have the biggest moves. And then if I use either an R5 or an R10, I'm either going to have a 9-to-1 or a 4-to-1 intraday reward to risk. So I don't have to worry about justifying, the quality of that move. So because I like to go short, I personally really will favor those, because the big gap down says it's already in play. It starts, as soon as it starts failing, I'm going to be on my favorite, like collapsing dragon kind of a move. And it's being driven by fear. Conversely, if that's a head fake and it moves the other way, then the next obvious price level is going to be wherever it closes. It's going to close the gap, and then sort of they got their tactical advantage. And then as soon as it closes the gap, we can say, all right, is the momentum going to continue that up, or was that the leg that was there, and then maybe it starts rolling over? So the upside can be a big move out of that adverse gap as well. It's just that that's not driven by the same kind of abject terror and fear that the breakdown has. The only fear on that one is fear of missing out and getting back to close the gap. And then it becomes a rational calculation that says, all right, if that was yesterday's close and it gapped down to here, and now here's the first easy move up to close the gap. The question is, was the news really a head fake and the gap was just an attempt to panic, but all the smart guys came in and bought quality on sale? And is that momentum going to continue for a range stat? So that's a rational calculation. That is greed driving that thing northward. when I'm thinking in that way, I really have to go back to all of the previous moves. How did it go into the close? Was that the end of a 10-day swing that was really great, and then this was just some kind of adverse move? Or was this a huge sell-off, and then there was a big gap down, but now everybody's buying it on sale? So unlike the big gap down and immediate sell-off, which is pure fear, the big gap down and then an immediate reversal makes me wonder, hey, what was the previous move? Was it a powerful move up and this is a reaction against it? Or was it a powerful move down and this is a continuation? The more unusual each of those preceding moves was, the more likely that there's going to be a huge follow through after the gap. All right. Does that all make sense?
It all makes sense, and I think Silver provided us with an example.
Yeah.
For example, the day before Friday on Thursday,
Yeah.
I traded silver actively on Thursday,
Yeah.
and the last rally during 2 to 3 p.m. caught me a little bit by surprise. But after it was rallying that much, I thought to myself, and this was just my intuition, which by the way, I'm keeping track of it based on your recommendation.
Yeah.
My intuition was that if I was trading options, that day would have been a great day to buy a put option, because I felt that my intuition told me that the rally on Thursday afternoon was unexplainable in silver, and the strength of the rally was unexplainable, and I thought, well, it makes sense. The herd has now grown accustomed to silver gapping up every single day, that these buyers, these guys are late to the party and they're going to buy it. And
Yeah.
sure enough, the next day it was a huge gap down. And because I trade the OR system, I went long after the first OR3 on silver, and it kind of broke on the upside, and then it hesitated for 1 or 2 or 3 bars, and I closed the position because it was failing to follow through.
Yeah, here it is. That's exactly the one. So this is 3 minutes
Mm-hmm.
On this is AGQ. That's just the one I was trading. It behaves exactly the same way as silver, but it's twice as volatile. So why not, So this is how this was Thursday. It kind of settled down. And then in the last 30 minutes, it had this unusual move. My intraday trades ended up getting out up in here because I just said I don't want to carry an overnight risk on this thing at all, and I was really happy with that move. And the earlier part of that day was let's see if I can pull this up. Yeah, this is kind of the tale of 2 days. Yeah, so the day before, so this was Thursday. So Wednesday closed nicely here, and it was like super happy. And then it opened up around 420 and then started collapsing. So I ended up getting short in this one when it gave this bracket, and then there was no upside at all and started failing. So I get short there with the stop above the high. And then this was like at 400. Was where I exited all swings. So this was an intraday turbo trade. And as soon as this got to here, yes, the Wednesdays closed and started dropping. I said, that's enough. And then it sold off all the way to 330, which is minus $70 on a $400 stock, is minus 25% in about 30 minutes. And then the recovery, the keep 70 was, if my entry is here and the maximum favorable excursion is here, I take that and go, take that distance, cut it in half, and then cut it in half again. My exit has to be right around in this region. So it comes to here, and then the rebound is there, and now I'm out of that day trade. That ends up setting me up for intraday SSC with a stop either at the bottom of the RL10 or at the bottom of the Dragon, whichever one you like. I usually just go bottom of the RL10. So there's my risk box. And now I'm long, and it goes, when it crosses the VWAP, I add a second position because now I have a low and a higher low. So I feel I can add this. And I'm either going to get out here or get out here because it can't break a new high. And then I don't want any overnight risk on this because I've exited all the swing trades, because that huge gap and followed by a 35% sell-off or whatever tells me this thing has now moved into phase 4 manic depression. So I don't want any overnight risk for the next 30 days. All right, so that takes us into Thursday. I know it's still in play. And what Thursday did was kind of a similar quick sell. And then a couple of these, and then exit somewhere out in here. And then it stabilizes in here. Then this little breakout was like really strange. What the heck is going on here? If you're still in this trade by this late, I wonder why. So somewhere in this region was the correct way to get out of this, because it had 2 or 3 chances to get back up to fair value. It did not. So my view is in the last hour, I'm getting out of the position and I won't chase it. It just makes me wonder, hey, that's interesting. So then the next day it gaps down to here. I think this was Friday. And there's your, and yeah, we're on 3-minute. So there's the OR3. So if I'm looking at that here, this is a huge gap. That's like 35%. So that's a big gap in anybody's league. So here's the open. So now I can put, say, an R10 on either side of it. So that would be something like this. And right from the opening movement, right? If it starts going up right away, even in the first minute, as soon as it breaches that, I can be long because it has moved a noise distance off that. And my thought is, from the open, this could go a full range stat, which is, probably like to about there. There's probably 2 range stats just in the move to close the gap. Let me see if that's a true statement. $60. Yeah. 16,350. Yeah, there's two range stats was the average, was the size of the actual gap. That's $120 of gap. So if it immediately starts rocketing north, then that's clear to me that guys are trying to get in as it goes back to yesterday's fair value, which was 380. So the first choice is a directional move regardless of the time. The second one is I can go from I can wait for the opening wherever it was, and then wait for the first bar to close, whatever. And now I have an OR3. That's my first 3-minute candle. And then I can say any price that breaks out higher than the OR3, I'm going to get long or I'm going to get short. Your observation at the start of this was important, that a lot of times, right after the gap, that thing will make one or two huge bars and then start to taper off. So if you wait for the OR3, or God forbid the OR10, it's already made 80% of the move, and all you got is the little bit left over. So the question is, how do I get into that earlier? Because my earlier discussion was from the open to the expected move, it can either be a slow roller or an explosion that peters off. And we're worried about how to get into that one. That's the one we actually want. So the first thing is, the larger the gap, the more likely it's a violent move right from the open. So put either an R10 or an R5 box on it. So you're either going to take the first breakout from the R5. So now I have to get this. Now I'm long, or I have to get that. And now I'm short. So that's one way to get around the problem of waiting too long to get in, is just wait for the move. I will tell you this: the bigger the gap, the more I use the R5 bracket or the R10 bracket. I'm comfortable using the R5 bracket. It doubles the size of the move, but there's still plenty of follow through. There's fewer false starts. So my preference is, on any gap day, is to use the R5 bracket. Does that make sense?
It does make sense, and that's exactly where I've been focusing on, using the
Yeah.
R5.
Yeah. Okay. So now the thing is, what if I've got 5 symbols? What if I have 5 symbols that are all at the bottom? They're all going to be large adverse gaps. I'm going to pick 1 or 2 for the first 30 minutes. And I'm just going to arbitrarily say it's either one that I recognize the name and I love it because yesterday was a big move and today was a big gap, or it's my old reliable or something like that. I'm just going to pick 1, not more than 2, and I'm going to use that. As soon as it gaps, I'm going to slap both of them on there. Like, even before the open, if you can see where the thing is indicating, you can go ahead and put it's like, here's where the open is going to be. And I can see in the pre-market, hey, this thing it already had a big sell off and it looks like it's going to open in this region. Here was the close. And then in the pre-market, you can see the size of the gap. And in the last few minutes, it's still monkeying around, but you have an idea that it's going to be in here. That's where I'll just split the difference and put an R5 and an R5 and put that order in. And then as soon as it opens and it breaks, I'm in. I could be in the first 5 seconds. So be it. And pick 1 or 2 and just get it done. If I decide to pick 1 and I don't feel comfortable about putting the stop limit order in, I'll put an alert in there, just put the price, and I'll have the order triggered up, ready to go with my finger, and just hit a market order, and off we go. So I'm not looking. Here's the problem that you described. The lion has prepared to hit that herd, and now 8 of them are all going. So I pick one for the first 30 minutes and just try to kill it. Then during the course of the day, I look, here's the first 30-minute block. Then there's four more 30-minute segments until we get into something like the lunch, which is about 90 minutes. And then there's another 4 30-minute segments. And then there's the last 30 minutes of the close. So the way I look at that is looking at the market in 30-minute segments. The first 30 minutes is explosive. The last 30 minutes is explosive, which is why I don't want to be in there. And this is where you often see that VWAP magnet. As the thing goes to a peak and then it closes, it reverses sharply to head to the VWAP. So I don't like trading that last 30 minutes because the VWAP magnet will take away all the gains that I made on the way up as it tries to run back to the VWAP. So I don't trade that last 30 minutes. The lunchtime, that middle 90 minutes is usually not very good because that's where you're getting a lot of consolidation from what? From that morning session, which is the first 30 minutes of explosion and then 4 more chances of follow through. So if I might see a sharp move like this one and then it peters out. That's exactly what it did. Explosive 30 minutes. If I had lined this up, it would have been like that. First 30-minute move, and then the next 30 minutes gave another move, and then the lunchtime was shitty, and then the afternoon, there was no follow through except this last, what the hell is that? So I don't trade that last 30 minutes. Well, so the larger problem is what do I do if I get 5 symbols that are all indicating large gap? I'm going to pick one, maximum 2 of my most favorite ones, and I'm going to take a look at those 5. What did they do yesterday? If this was a big move up or a big move down, I'm going to prefer that because then I am not surprised at a big gap, and I think this is going to be a big follow through. So I'm going to try to pick the ones that have the combination of the biggest gap now and the most outrageous move yesterday. What's the most outrageous move yesterday? Well, I can take the range divided by the range stat. That's what this column does. So silver, this was from the day, this was at the close, but so it would have described today's move in silver as a 2.84 range stat day. I mean, it moved 2.8 range stats on Friday. So that tells me Monday that silver is probably going to be moving. So if I look at the day ahead, I can take the range stat divided or range divided by range stat. So silver was huge. Wheat and precious metals was 1.7. Uranium was 1.5. Mexico was 1.6. The least mobile move was Palantir only had 0.6 of a range stat. Strange. It was almost the lack of volatility. So one of the things, yeah, go ahead.
And Palantir had 2 full range stat days back to back the prior 2 days, and I missed both of those days, even though it was on my target.
Yeah. So So in terms of making a preference, so this was the close on Friday, and I know uh I know what, let me reverse it. I know what the range divided by the range stat is. I can use that column. It's lagging, just sorry. I can use that column to make a preference on which one. So I'm going to look, because I have it inverted, I'm really going to be looking at these things. Anything greater than 1.0 in that column had bigger than a range stat move, so that's abnormal. A 1.0 means only 1/6 of the time in the past did it move bigger than that. So that by definition is a huge move. So I'm going to prefer things that had a large range divided by range stat. So then if I see those having a big gap, I'll just pick the one that has the combination, I'll say, biggest gap and biggest range stat index. I just want the ones that had the most extraordinary move yesterday and the ones that right from the open are going to have the hugest move. And then I'm probably going to use the R5 right away, but I'm also going to, I could end up using both of those. Like if it closed here and then the gap was here, and then I put a R5 on either side of it, and that thing has me short, and then 3 minutes in, the bar looks like this. Then the next bar opens and goes. Now I'm 3 to 6 minutes in. I can put my OR3 on that. So I might have gotten the entry here because it broke down an R5. And then when the OR3 forms, and then the next bar is continuing that way, I could maybe add second position, or I say, well, I just got confirmation that the OR3, that this thing is going. So maybe that's the time that I can take here's my OR. So I got short. And now it confirms with the OR3 that it's going short. That may be the time that I just say, let me take this and give me the no lose plus dinner for 2 stop rather than putting a second position on. I want to make sure I get the second. I want to get to the no lose plus dinner for 2. And now I can take my R5 and I can say, look, 1, 2, 3, 4. That's my range stat move.
So in the case of silver on Friday, going back to silver again because it has
Yeah.
such a great move.
Yeah.
The first OR3 generated. I mean, the first movement out of the OR3 was a long, and then it opened up and it stayed up. Well,
Yeah.
I don't know,
So,
3,
so
4,
then
5 bars.
so then it comes here. And then you say, well, if I'm short from here, depending on the size of let me see what the R5 on the thing is, $60. So if I'm short from here on the I'm sorry, that's EWW. Let me go back to silver. Anyway, my point is, you got to weigh which one you want is the R5 move or the OR3 move, and half the time you'll be right. You just got to pick the one that you want. So yeah, let me.
Yeah. So there you go. The first the OR3.
I want to
There
try to
you go.
get this so it's easier to see what's going on. That may be all it's not letting me shoot. Sorry. Oops, accidentally hit close. It'll be back in a second.
No problem. Anyway, we have the OR3 and then executor long. It floated around for 4 or 5 3-minute bars.
Yeah, it's failure to follow through.
Yes, exactly.
Yeah.
And I decided to pull the trigger on the failure to follow through.
So you took the short side?
I did not take the short side. I exited the long on a fail to follow through.
Oh, okay. That may be the best I can get right there. Because otherwise it's not showing the magnitude of the gap, but
yeah. So we
all
can see the opening range, 1, 2, 3, 4, 6, 7 bars. And when it started coming into the range, I just exited the position.
So here's the OR3.
Mm-hmm.
There's our, whatever it is, minus 30% gap. So now, interesting, let's just check something from the gap. So the gap was about, call it 270. The R5 is $12. So 270 plus 12, so 282. That is an R5. That's an R5 box. That's $12 off the open. So the R5 entry long is legitimately, whoops. The R5 entry long is legitimately there with a stop right here. And then the R5 short is approximately like that. All right. So we could get an R5 entry here. We might have gotten that one. I think you probably hit this one because it did not fail further and started breaking out. So that's about 15 or 20 minutes in. Here's the open. So that's 15 minutes in. That's 5 bars. So this is 30 minutes in. This is where I ended up getting short in here. The fact that after 30 minutes in and after a few efforts to get long, it wasn't closing a 30. Like, if you wanted to buy silver, wouldn't you be interested in buying silver at that's a 15% discount in silver. That's a 30% on sale in the 2X silver. Wouldn't you be interested in buying silver on sale? Well, yeah, only a few people did. So when that rolled over and came down below the entry, I'm long here with a like an R5 because I think there's still from the high of the day, and I'm below the VWAP. I'm ready for that thing for more pain and suffering, and that does nothing but this. And so when it breaks like below There's the PSAR to the downside and the second PSAR to the downside. At this point, I've got 2R in hand with momentum and no buying pressure whatsoever. And that thing collapses another huge amount. So this is where, oh my Kenneth. So on this failure, when it comes below the VWAP, me, second position, third position, fourth position, holy hell's bells. And then I got to be out here because it had 30 minutes to fail further, and it didn't. I actually had a ZSL trade. There's a ZSL trade, which is 2x silver short, which means that it would look like this. It would be taking the other side of the trade. Yeah, it was in here. There's a 2x silver short, which is getting ready to break out to the upside. So it's sometimes easier to trade that one. But yeah, anyway, so that's the way that trade unfolds with either the R5 or the R10 or the timing. And my big takeaway on that one was, look, after a 15 or 30%, depending which symbol you're using, if it had 30 minutes, and this is the halfway, this is closing half the gap, and that's just closing the gap. If this is all that it did in 30 minutes, at the first sign of failure going below the VWAP, I'm ready to pound that thing because there's more of that coming. That's just, to me, that's kind of automatic. Now, you see that once every 3 years in silver. But the idea is, what was right from the gap opening on my screen of tradables, I'm just looking for the things that were sucking the most. Like Rigetti was horrible all day. Rigetti's one that's even easier to see. It was a big gap down. It had a big run up at the close, then it gapped down to here. Here's your OR3. There's your short position. That keeps 70%. You might have tried this one. When it fails below the VWAP, you're short again. It fails at the VWAP, you're short again. It fails at the Bollinger Band mean, you're short again. So these symbols at the left-hand side that are very liquid and diverse, and you compare that to story stocks like Rigetti that are very narrowly traded, AV, BBAI. Once these things get directional intraday, they just tend to go. Whereas there's always guys that are buying and selling the S&P for short-term tactical reasons. So you tend to get a lot more choppiness on the move. When these things fail, they tend to fail big, fast, and in a hurry. So now as I'm thinking about organizing my trading day, again, like I showed before, the first 30 minutes, the last 30 minutes, the lunchtime compression. This is where I'm thinking, that first 30-minute move, I'm going to focus. Then I'm going to scan all my symbols and see how they're doing to see if any of them are setting up like kata twos to the downside or a harsh sell off and then kata twos to the upside. That's where I'm trying to get. I got about 2 hours in here, 4 30-minute segments where the follow through after the opening 30 minutes happens, and then usually some consolidation. And then I'm interested what happens in the afternoon. And it might look something like this. Let's say here's the close. And then it opened, big gap down, and it sold off. And then the first 30 minutes, it had a nice big recovery. So I might have gotten some of this, cashed it. I might have gotten some of that SSC. And now maybe it's in a set of kata twos and then stabilizes. And then the lunchtime just kind of drifts and I get some very nice tight consolidation. Now I can say from the low of the day to the high of the day, maybe that's 0.8 of a range stat, and then the range stat might be here. So this breakout, I can say, if it's going to resume in the afternoon, the move to a range stat is there. Is that enough? If that was my risk, is there enough for 2 or 3 to 1? Okay, then I can play the breakout. Or if it starts failing this way, maybe it comes all the way back to the opening. Or maybe the VWAP was like this. And then my downside targets could look like a breakout and then a move to the VWAP. Maybe there's 2 to 1. And because of the size of the early move, there's coming back to here is a target, coming back to the VWAP. So maybe that's leg 1 and maybe that's leg 2. So if I saw this kind of a move and then a consolidation, I have a reasonable intraday move to start playing inside the middle or inside the afternoon 2 hour segment. And I got 4 30-minute segments. And I'm going to try to be out of it. I don't really want to be in here in the last 30 minutes because too often that thing is going to run, it's going to run back to the VWAP and it can negate most of the gains that I had in here. Now, does that structure make sense to you? Is that answering any questions or adding clarity?
It is adding clarity.
Okay.
The Palantir, I mean, Rigetti is a great example. If we can switch back to the daily chart, that's exactly what I want to show you because this is one of the ones that I missed.
Yeah. Let's see here. What I'm showing is RGTX because I like trade. It's a double Rigetti.
Okay. All right.
Just because. Yeah. So this is why I'm interested in Rigetti long term.
Right.
It went from 10 to 150, back down to 10 or 7. That's in the double. Rigetti, the actual went from 15 to 60, back down here. So yeah, so now if we come this way and looking at Rigetti, this was yeah.
So if you see, it had a very small range on
yeah. So
on,
yeah. So
this whole Tuesday,
this whole crap around the SMA 30, And then suddenly from about here, it had a breakdown that reversed. It had a breakdown that instead of coming back into here, did this consolidate into a doji. That was Wednesday. And then Thursday, it did this. And then Friday, it did that. So it had two huge directional days in a row. So this was, Wednesday was the perfect critical state on this one because we know, number one, it's an extremely volatile daily bar. The daily bar range is always huge and it's largely directional. Like, look at this one: opens, closes. This one opens, sells off, goes way up, comes all the way back. Big range. This one opens, sells off, gains, comes back. Huge days. Opens, goes straight up, closes. So this thing has huge ranges. It moves 10% of its range in a day. Here's one: opens, closes, opens, closes. And then the great decay. No follow through until it reaches a peak. The RL10 reverses. So there's my support level. Here's my peak level. It does this and gives me a 1-2. Here's a gap up. If I'd put my little R5 boxes, I get a huge one-day move. When that fails, I get huge. Anyway, so RGTI day to day to day just has great big percentage moves all the time. So then it stabilizes. It has no swing direction whatsoever. The slope of the RL30 goes from steep down to pure flat. That is the very definition of an SQC. PSAR flips. There's your lower support level. First alert, second alert. And now this day collapses into the tiniest little doji of the last 30 days. Smallest doji of the last 30 days. So I'm always ready to get long any breakout from there.
Right. Then the day before had been a small day, so Tuesday had been a very small day.
Yeah, it was like huge, huge, small, right. Small, smallest.
So Wednesday, I focused all day on it. It didn't do anything. It didn't leave the range. Yeah. And then Thursday, I missed it.
That's right. Here's the way I look at that. If this was Tuesday and it didn't leave the range, and Wednesday was even smaller, I just tighten up my bracket and I look like this. Here was Tuesday's. Oh, it didn't break out either way. That's okay. Tiny doji, it's now this and this. So my spring is compressing. That lower support level is acting like support. So each time that it doesn't break out, I get more interested in it, right? So, yeah, so as these ranges start getting more and more compressed, the tighter that gets, the happier I am to take that. Again, the first time that it broke out here, it did not follow through. It ran back up into the safety. The second time it broke down, it closed. And now this consolidation is happening outside of the previous consolidation. So this is if I were to diagram it, it's a consolidation, fake, 1, 2, 3, and now it's consolidating here. So I look at that as I just take the middle of that and say, that's the middle of that consolidation. And now this little piece here, even tighter consolidation. So on whatever it was, if Wednesday didn't break out, I just tighten that up. And now if it breaks out to the long side, I'm looking at the size of the consolidation compared to the midpoint of the consolidation. 2-to-1, yep. And then if it breaks down, I'm always ready to play fear. And I can just say, look, from middle of consolidation to the middle of the consolidation was 2. It can go 2 that way. So now I got 2-to-1 in either direction. And I'll just and once that consolidation is happening, if that bar, this was Wednesdays, if that doesn't break out today, but it just is this, I'm happy to do that. And now I can buy this breakout, and I might buy a second position there because this is still in play. And that's a way to get 2 quick ones in. And I might do short and then a second short. And then this is technically the yellow zone. And now my choice is I can add a second position here or here, or I can just say to myself, you know what? I need to get my stop to no lose plus dinner for 2 and not worry about the second position. And then I can go back in time and say, where were my previous support levels that broke that allowed this big move down to happen? And now I can start saying a return to support, is that going to act as resistance? If not, I can add a position there. If it gets through there and comes up to this one, what's it going to do? Is that going to act as resistance? If so, I can exit. If not, I can add a position. So I'm always taking a look at ranges like this. This was the move to consolidation. And where were all the successful COTA 2s? As this thing sells off and stabilizes, if I'm looking at the upside, what I can do is take a look at whatever the peak was, whatever these little previous resistance levels were. And now I can say the breakout from here can get to this level, to this level, to this level as well. And if I know that my risk is something like that, I can just say, if it gets to here and starts, do I want to keep that? Or if it gets up into here and starts failing, what's my R multiple on the stack? And then this is where the keep 70% rule, whatever the maximum excursion was, and starts to fail, if that was my entry and that was the peak, half and half again, that's about 75%.
Are you applying the 70% after the 2R title deal?
Yeah. Once I get 2R,
Yeah.
I want to keep 1.5. That's about 75%.
Yeah.
So,
Perfect.
and then at the same time, I may end up on a really good move. That thing might, if that's the price, the RL10 might not even have started to roll over yet. And once I get past 2R, I'm invoking this keep 70% anyway. Because I don't want to let a 2R win go to zero. I want to keep about 1.4, 1.5. But when I watch the top of that, once that price, instead of going up, starts to decay, you're going to see that the RL10 starts to flatten out. Instead of going higher, as soon as that thing flattens out or starts reversing, I have to have the 0.70 in, like there's my 0.70. And that's just how much room, that's how much room I'm going to give it in order to keep 70%. And it's going to say, well, what are you going to do? Are you going to continue to go higher? If so, I could add a position. If not, I can exit that position. And now I'm setting up my next kata 2. Here was where I got in. And then here was my first risk. That's now the yellow zone. Whatever the initial failure point was, if this thing comes all the way back, I got to be short here. But meanwhile, if I took my exit here in order to preserve my gain, this whole region is stalking kata 2. Because somewhere in here, from between where I exited this whole region right here is kata 2 region. And the reason is it's still positive because this was all good gains and it's still higher than the consolidation. The only thing that happened was I decided to keep all of that, which is why I got out here. So I still have a favorable opinion because this was all good and green. I have a favorable opinion about this symbol because it hasn't violated the initial setup. So as price comes through my kata 2 exit and is coming down to this line, as long as it's in this region, what I'm looking for is it to find support anywhere in here. And I don't care where, because wherever it finds support, wherever it finds support in here is going to be a higher support than here. So the combination of this support, which got me into the trade, and the higher low now is going to make all of these caught it. I'm going to make it in yellow so it stands out a little better. That is a COTA 2 potential. And where it confirms is if it ever breaks above the previous RL10, that's where it's an emerging dragon. If this thing gets above where I exited, then I feel still pretty smart. Like if I can enter anywhere in here and then it goes higher than where I exited on the front end, all I did was I feel like I got my original trade on, but with a better price than my exit. And what I did was I added value by exiting here, and I saved this in order to re-enter here. This is actually that little bit is extra payment because I exited here and got the same trade but here. So I'm looking at all of this space as a way to get COTA 2. I'm not trying to get stop and reverse short. I'm just waiting to get a better play. Because until this original stop is violated, I'm entitled to have a long side bias. Right? But as soon as that hits, if this original risk was hit, now it's no longer COTA 2s. It's now all the way back to the short side. Whatever the short side trade was out of this, now that's in play. So in terms of management, what I had to have for these COTA 2s was a good, successful original trade. And then what that does is it gives me a bias to prefer the upside with COTA 2s as long as that original stop holds. Hey, what if I can't get a COTA 2 in here at all and it just keeps drifting? And now it's in the lunch. Easy. As long as this original risk holds, and that's my consolidation, and that's my midpoint, I'm willing to buy the breakout with a 1R stop here. Because if this thing works, then this is going to look at some point, the RL10 is going to reverse, and this is going to look like strong support. And I have this support, which never got violated, and I have a higher low. That makes this breakout reasonable. What I had to see was those Z3 lines probably had to catch up and make this a Z3 pinch. That would be good. And I have to have enough time left in the day before the close. That should be an MTIME. I have to have enough time left in the day to make that trade. Now, the other side of that is, if that's what it looks like intraday, it's the same thing on the daily bars. If I get I get this, I'm going to highlight every place where the RL10 turned. So now the RL10 is inside this. I got the PSAR dots converging. Here's the low. Here's the high. Yeah, I can get some false starts, but my intraday stop's going to protect me. But when the swing trade support and resistance is violated, there's my swing trade high and low based on RL10 turning points. Here's where the RL10 hit. By the way, that's reinforced by this one. There's my range box. And now this stuff is all good. Here, short. And then you can either say, there's my SMA 30. I'm going to take that as execution risk and maybe take that as position sizing risk. So if this thing reversed against me and got me out, I'd take a minus 0.5. Or you can just say, look, that's $1.50. If I'm short at 23, and that's 24 and a half, RGTI's range stat is 260. I'd probably just take that as the top of the range as my position sizing. But I would execute if this thing did not fail further. Come on. If this thing got here and then started reversing, I wouldn't stick around longer than halfway. So I'm going to cap my loss at a 0.5. And then this thing on a daily basis just keeps collapsing like a crazy man. So I can use that same mentality for trade framing from the swing trade in order to shape the day trade. In the same way with Rigetti. Now, 2 days later, this thing broke below the doji here. There's a doji. It broke below, and that thing was a huge downside directional day that finished here. So now I can say, going into the next day, this thing is in a clear sell-off, and price is right here at 20. If it goes below that, anytime the next day, I'm going to be short like a big dog. So I can trade it tactically inside here, but if it ever breaks below that, I have a signal that says be short in a hurry. And now what I'm doing is I can see this thing went from a consolidation. The more that happens, I'm starting to get this very directional bias to the downside. So now, let's say it traded like that for 2 or 3 days. And then the last day in that series ends up becoming some little doji day. That's going to be the last day in that series. Same thing. Huge sell-off, terminating in a doji. Tomorrow I'm going to be short here. Tomorrow I'm going to be long here. And I think it's going to get back to this. So now I can say, there's my reward. And if this is my risk, halfway, halfway. Great. I got a four-step ladder just back to this region. That's no different than what I just did on the intraday piece, only now I can use daily bars. And then I already know that if yesterday's little doji low does not hold, this thing is going to collapse to the downside. And the size of that move could be the size of this move. That's how big the next downward direction is going to go. And I have no worries about that because that's fear. The upside move, I got to calibrate, especially if it's a retracement after a huge sell off, because that's going to be tentative. So I'm going to be very meticulous about that because that's greed. But the short side is going to be taking advantage of fear. And once again, on the daily chart, just like elsewhere, that SMA 30 gives me the market direction. SMA 30 got flat here in the middle. SMA 30 is flat here. SMA 30 is diagonal down here. Oh, come on, pen. So in terms of detecting signal from noise, now the SMA 30 just started to get downward right here. So this thing is live. Rigetti is live to the downside. Check or hold.
Check.
So now if Rigetti is at 18 right here, if I want to get a larger sense of what's available, I can go out to 3 days. And now look at this sumbitch. Here's where way back in the day, the movement from 15 up to 53. And now I can also say, look at on a 3 day, this really stands out. This is just the start, and this is a log scale. Oh, no, that's arithmetic. If I put that on a log scale, it's even, yeah. You can see this move back to 15 is still very much in play because price is here. Let's see. Yeah, so my price is still there. So a rebound to here is 18 to 23. That's a 30% move. The move from 18 to 15 is 15%. So that thing is still hugely in play for Monday, which is tomorrow. Check or hold. So I would love it to open exactly where it closed, and then I'll just play an R5 move away. If it's a huge gap, I'll put the R5 bracket on the gap, and I'm just going to hold on. And I know that the downside move is 3 times more powerful than the upside. And so I can calibrate that kind of a move in the same way that back here, this thing went to almost 60 and then came back to 45. And now here was a little gap up. If I take my, yeah, sorry. If I just put from where it opened, if I put my little R5 box on there, let's see what happens when we go back and look at that. because that one could equally as likely move from here back up to 60 as from here down to 30. Because both of those are kind of like equally likely. This is the breakout. And look how nice that PSAR dot is. So the breakout from the little red box could go to either of those two circles, check or hold.
Check, understood.
Try to find where that is.
It's sitting right on top of the prior high, long-term high.
Yeah, yeah. That little I think that's the RL 150-ish, that purple line right there, which is pretty cool. Yeah, and all we're trying to do is see that 1-day move out of that little red box. Let's see. Yeah, so this little red box was the breakout from that little consolidation right there. And the next day essentially is that day. And then what that does is that box leads to, now when this one can't even break above the midpoint, this is my argument why the midpoint of a consolidation range is a reasonable place to put an execution stop. So what I want you to see on this one is so this was that consolidation range of the previous day. It actually went from here and made this trade. So the breakdown from that the day after we saw that pullback, it gave you this trade, and then it consolidated inside this red box. So if I make so that's the consolidation zone in the red box. So the next day it breaks down. I'm entitled to get short here with the stop right there. And until that stop ever gets violated, there's no upside. Like, this was great. Awesome. So I'm stalking Kata 2s. It had a chance to do a Kata 2 here. It only got to here. And then it failed below the low of the Kata 2. Dude, this thing was supposed to go and get above this. It was supposed to keep going. It did not. It came down to here, consolidated, then broke down. And then this is half of that consolidation zone is my buffer. The indication that this thing might be back is if it breaks above, it has to break above the previous consolidation. It had to break above this level. So then otherwise, if I see VWAPs that are looking like this, that is a huge short. That's a COTA 2 short. Comes down in here, finds support, tries to recover. It cannot. RL or the RL10 and the VWAP roll over. There's a COTA 2. There's a CD. Smash. Smash. Uh-oh. R10 reverses. Dragon reverses. PSAR's reverse. Has a nice run up 1-day move to here. Can't get any higher. Each little R10 fails. Fails. Right here, you can see that is a huge critical state. Look how big that box is compared to this. It's the same box. So that breakdown, I'm short. I expect it could get to here and here. All three of those are targets. So that's really a target zone. All of that is a target zone. Then all of this, from the original short trade, this is a target zone at 30. Checker hold.
Check.
And then let's see if I can. Boy, this is really bad lag. That thing not only breaks below 30, it breaks all the way down to 21. And so now here we are in this little region. That's the same kind of consolidation zone as before. It's equally likely to break down to here as it is to up here. It has to get above 26 to really be interesting. But if it does get above there, it can get to this. Which is halfway to the long-term value of this. So that's fine. Failure to fail. It gets right to where the projection. I mean, come on. If this fails, if it fails below here, where do I think it can get to? I think it can get to here, and I think it can get to here. If it succeeds, I think it can get to there and get to there. I don't care which way it goes. You know, it got to here out of this little breakdown or out of this breakdown. So it could get back to there. It could get back to here. It can get back to here. And it can get to here. Probably got short for a while. COTA 2. It gets right to where it's supposed to the last time. That was a gap that it sprung. So when it broke below that as a gap, then this became a really powerful short inside here. Gets right to where it's supposed to every time. So my point is just knowing what the size of the breathing moves, those standard moves looks like, is part of the way you calibrate your intraday move. It starts off with the range stat. It includes the frog box. It looks for those turning points from the last interesting moves. And then you start estimating where it could reasonably go. So you end up eliminating your directional bias and you simply look for what is the size of the box that tells me it's no longer in play or it's not out of position. So I just look at this and say the close. This blue box is my 10-day range. So this is it made a 10-day low here. And the price is sitting right there. So if that thing breaks below, 18, I'm short in a big way. So now this is I'm looking just at a 2-hour chart. So no, it should not be controversial to say this thing, if it fails out of here, it's going to get to this blue line, which is kind of where just before the explosive move up happened. That's where the long-term guys all thought fair value was. So now what if it fails below that? Here and probably here. So that's my glide path from short at 18, target 15, 11. And if you're going to do that, you might as well make that, you might as well just make it every $2. That's your downside targeting. But if it works to the upside, what was once resistance is now, or was once support, is now resistance, and that is 21. That's a 15% move from here to there. That's all I need, right? So now when I'm going to zoom in, I'll just take those two until I can see that. Would I be wrong to do this? I'll just put that little gizmo right there. So that we can, oops, I thought I could see it. So maybe that's all I have. If I wanted to refine my entry for Rigetti tomorrow, I hope that it opens inside this. That would be helpful. If it could open inside that little piece, because this is just that's that was like the previous day's high. So I could go a breakout here with 1, 2, 3 just to the top of the high, or here, or the SMA 30. So the upside recovery trade is there, and the downside recovery trade is 15% to there. That's my preferred trade from Rigetti. What if it breaks out outside of that range? If it opens in one of those two circles, then I'm going to use the R5 bracket and follow price 2 times. And that's my trade frame for Rigetti. And you could substitute exactly that structure for any of the ones that have narrowed to your interest list. Like silver will be the same thing. I'll be short silver. This is SLV, so I'll be short silver certainly by 70. And then long by probably above the VWAP. I would want to see it north of the VWAP. So technically, could I use the last 2 hours of consolidation? Yeah, probably so. But not later than that. I have to play that. And then my upside target would be get back to the SMA 30. And then the downside would be probably 10-day low. And then maybe here, the long-term support level or long-term fair value. So I could trade that with silver. And then I'm free to watch the opening 1 to 3 to 10 minutes, knowing that is my my larger time frame that justifies this. Does that make sense?
It does.